I'm Tetsushi Sonobe of ADBI. Today we are delighted to welcome Professor Weiping Wu of Columbia University to our distinguished speaker series. I think she needs no introduction. She is well known for her innovative studies of urban dynamics in developing countries, global urbanization, migrant housing, and creative clusters, among others. She is the director of the Urban Planning Program of Columbia University. So after me, Mr. Yong will speak. So Mr. Yong, floor is yours.
Okay, thank you, Mr. Dean. And good morning, everyone. I'm Yong Ye, Director of the ADB's Urban and Water Division in the Central and West Asia Department. I would like to congratulate my colleagues in ADBI and the Urban Sector Group for organizing this important webinar. And a very warm welcome and thanks to the Professor Weiping Wu, who I believe is presenting from New York City. A very good evening to you, Professor Wu. The topic of this webinar is highly relevant to ADB's urban operations. The countries where I work in Central and West Asia, including Georgia, Armenia, Uzbekistan, are faced with the complex challenge of meeting expanding urban demands. Cities throughout the region are unable to meet the increasing demand for services in areas such as water supply, sanitation, transport, and energy. This is mainly because they lack the enabling environment to attract and sustain both public and private investment, including supportive policies, regulations, institutions, and governance systems. ADB's Strategy 2030 aims to make cities more livable, and integrated solutions to help countries build cities that are green, competitive, resilient, and inclusive. We do this through a holistic approach of infrastructure investment, policy dialogue, institutional capacity development. We are always looking for new and innovative ways to support our clients. With this in mind, we greatly look forward to listening to Professor Wu and learning more from her expertise and impressive experience on this important topic. Thank you very much.
Thank you very much, Yong. So, Professor Wu, if you would like to start your presentation, you have 40 to 45 minutes. We will take Q&A at the end, which will be around 10 to 15 minutes. And I will also encourage participants and attendees to use the chat facility to make questions throughout the presentation. So over to Professor Wu, please go ahead.
Thank you very much. Thank you, Dean Sonobo, and thank you, Mr. Young. And I also want to thank Mr. Ron Slagan in the Central and West Asia Department along from our program, Urban Planning at Columbia. So it's really very much my pleasure to have this opportunity to share my work with you and also to really learn from your work. And I look forward to a lively Q&A session. So the title of my talk today focuses on private and institutional investment in urban infrastructure. And I want to first define urban infrastructure really quickly. And that is, in this case, we're looking at four sectors primarily, and that includes transport, telecommunication, water, and sewage. And then, actually, I'm blanking on the fourth sector, but we'll look at it with power, energy, right? So those are the four sectors. And before I dive into the research on private and institutional investment, I want to quickly give my motivation. Why am I interested in this topic? And so I have been working on urban development in China for many years, and I've been also looking at how China finances its urban infrastructure. And originally, I was focusing on public investment, right? State allocations and budget allocations. And when I was looking at it, it was very clear China finances its urban infrastructure, or shall I say, Chinese cities finance their urban infrastructure in very different ways from other countries around the world. So if you take a look at this slide, you will see in many industrialized countries, particularly, let's say in United States or in countries where the capital markets are very developed, borrowing from capital markets, particularly through municipal bonds, is really the most common way of financing urban infrastructure, right? And then secondly is through the collection of local taxes, particularly property taxes. So where I live, in New York, or in Boston, or in all of the American cities, and including in many other places around the world, those are the key sources of finance for urban infrastructure. And then we go to other developing countries, especially those where capital markets are not as well developed. We do see local taxes are being more important. And then subsequently, we'll also see other types of fiscal allocations and borrowing. In China, it really is quite unique. And I will show some data and the trends, then you will see sort of why I'm motivated now to look at institutional and private investment. So for urban infrastructure in China, the primary sources of funding are, number one, land lease and transfer fees. It's this very unique way of generating revenues out of leasing of publicly owned land by leasing out primarily use rights. And then secondly, borrowing. But this borrowing is not from private banks or capital markets. It's borrowing primarily from state-owned banks. And then there is a small part of local taxes. So it's really dominated by state-driven finance for urban infrastructure, right? Land is state-owned in Chinese cities. The borrowing is from state banks. And so if you can see, I apologize, I'm not sure on the small screen this will show up as well, but you can see over time across Chinese cities, the different sources of urban infrastructure financing has shifted, and over time, as you can see, the most important source across all Chinese cities is now land transfer revenue. And then you look at cities in different regions, and over time, that change also is fairly significant, and particularly on the East Coast or the Eastern region, the reliance on land use transfer or land transfer revenues is dominant. Now, as you move to less developed regions in the central and western areas, that reliance becomes smaller, and then fiscal allocations through basically budgetary allocations of local governments becomes a little bit bigger. And that, it's fairly natural, right? Because land is not as attractive in less developed regions, particularly to investors and developers and so on. So for Chinese urban infrastructure, land is really important. And it is, so in this case, I wanted to also introduce to you a little bit of this land financing part of infrastructure in China. So land is, of course, a source of finance in the lower right side of the circle, but it's also, reflects how urbanization proceeds in terms of its morphology. So the top part of the right side of the circle, and then land ownership regime in China is very distinct, right? Only about a handful of countries, particularly somewhat more distinctive countries around the world, like Singapore, Sweden, most of the Netherlands cities, and Hong Kong, the territory, and China, to some extent, a few other places. But you can count with your two hands, of course, number of African countries in which urban land is state-owned and they use a leasehold system. And so in that case, China's practices actually has implications for these countries, and also countries that are just beginning to develop and hoping to the so-called generate revenues off of land. But this challenge, so a challenge arises basically that, as you can see from this flow chart, that the public sector is incredibly important in utilizing land as a collateral, as a revenue source for building infrastructure. So there are thousands, quote unquote, local government financed vehicles in Chinese cities. They're also called urban development corporations. They are not exactly the local governments. They are quasi-public corporations or joint ventures. And so if you think about municipal bonds in the West, they are issued by local governments. So credit ratings of local governments are based on these sovereign units. But in China, these local government financing vehicles are not exactly sovereign units. They do have the support of local governments, but they have a full right of being able to engage in market behaviors. That is, for instance, to issue project bonds. And so with that hybrid positioning of these local government financing vehicles, they get support by from the local government in the form of cheap land. And then they turn around, lease out at a higher rate, and engage in real estate kinds of transactions and use such incomes to develop infrastructure. In the meantime, local government financing vehicles also use urban land as a form of collateral or sources of future income to borrow from state banks, right? So now land is not only a source of revenue, it's also a source of future revenue. And with that in the calculus, that there's been quite significant volume of investment going into urban infrastructure across Chinese cities, especially on the East Coast. And that's how we see that infrastructure development has been so fast and enormous in scale and quite advanced in technological levels, right? You know, we're looking at high-speed rail, but that's not necessarily within cities, but high-speed rail stations, you know, light rails, subways, renewable energy facilities, water and sewage. All of these sectors have been improving service levels tremendously since the 1990s. And so it's been over 20 years of progress. So it all looks good, right? It all looks very promising. And there's lies my motivation of studying private and institutional investment. Behind this very drastic progress of infrastructure development, local governments in China have been getting into serious debts because of the, you know, sort of unrestrained ability to borrow from state banks. So if you think about Chinese state-owned enterprises in the 80s and 90s, where they have these so-called non-performing loans, imagine that for local governments. A lot of these loans from state banks were not fully returned, and so local governments were getting into debts. And there was estimate of such debt mounting to be roughly anywhere between 27 to 30% of China's GDP as of just 2 or 3 years ago. That's one challenge here. That is, it's not all rosy. And the second challenge has to do with, if you look at number of cities, again, there's lots of information on this chart, but you can see in eastern regions, some of the big cities like Shanghai, right? Or, Tianjin or Beijing, especially the three big cities, where those are the short red bars in the eastern region to the right. You see the physical gap is the blue dots, and the land supply is the orange bar. There's a huge difference in between, right? That is to say, land is running out. Land is running out as a source of revenue for future infrastructure building. And the physical gap is huge. And that's another big topic which I can answer a question if you are interested in China. Generally, local government revenues and expenditure or responsibilities have real distance in between, and that's the fiscal gap. So the second challenge is that land as a source of infrastructure financing is not very sustainable. So the debt issue, this non-sustainability issue, forced lots of cities to look elsewhere for sources of financing for infrastructure, and that's where my interest lies. And so it takes a long time to get to that, but part of the reason has also to do with that private and institutional investments in Chinese infrastructure or urban infrastructure has been very limited in general, but it's also limited in many other countries as well. So I will introduce a number of emerging economies so you can see. So what is then private investment in infrastructure, right? So we all know there are at least 4 different forms. One is what we call management and lease contract. That is, it's public infrastructure, it's public road, but we lease it out from the city for a private company to run it. And then the second type of private investment in infrastructure is to build new infrastructure types of projects, and that sometimes combines with concession. That is some kind of ownership being given to the private entities to own for a limited time. And so concession and greenfield developments often go together. And then divestiture is completely privatized, right? You let a private company build a water treatment plant and own it forever or indefinitely, right? Or what we call privatized infrastructure, like premier water supply networks for select residential developments. So you can see the type of asset ownership, and it sort of moves from public in concession and management contract to gradually private and or joint venture in terms of some greenfield development, and then private sector invest. So the responsibility of the private sector is primarily of investment, right? And the length of time is also different, and so on and so forth. And so most involve new types of infrastructure. And so greenfield is the kind of private infrastructure investment that's most common in developing countries, and particularly in China. And so if you look at the different forms of greenfield development, which I won't go into detail, but we know there's build, operate and transfer, BOT, right? Build, operate and own, BOO, which is basically divestiture. Essentially, these different forms gives the public sector different degrees of responsibility as well as risk, right? So the higher responsibility the public sector has, the less the risk. But, if you give it to the private, if it's taken more of ownership, it's also higher risk. So it's a balance between whether public sector or private sector has more risk, or whether which side carried the burden of upfront investment. And for instance, totally greenfield development, build and own and transfer private responsibilities is much higher than just design and build instead of owning it for private sector. So with that in mind, let's take a look at about a handful of emerging economies here. And this is a data set that the World Bank has built over almost 30 years. So this here goes from 1990, the earliest data available, to 2017, roughly, almost 30 years, including just about all countries. So I only have chosen about a handful of emerging economies to just see comparably at similar development stage. As you can see, China being a very large country with a very large urban sector and rapidly urbanizing country, it's the light blue right in the middle. Its level of private investment is actually rather low, lower than Brazil, lower than India, and lower than most of the other countries here, right? And that's kind of interesting. You would think China would be able to attract a lot more investment in infrastructure from private sources, just as it has done in manufacturing, but it hasn't. And so if we take a look at the 4 sectors of infrastructure, we can also see that transport and energy tend to be the biggest sectors that attract private investment. That's in terms of project counts, and then you can look at in terms of investment volume, then transport and energy again is really big, with the exception of a couple countries like Russia and South Africa and Turkey, in which telecom is very big. And what kind of is striking here is the water and sewage sector does not attract a whole lot of investment, and which also speaks to that the per project investment is smaller in these projects. Because if you look at project counts, it's actually sort of a little more sizable, right? And then we look at type of private investment across these countries. It's also striking that greenfield projects are the most sort of significant, right, across countries. India, most significant, and then China, and just about everyone. And divestiture, essentially wholesale privatization, is the most common in Russia in terms of what we look at investment volumes. And then when you then go into the different types of greenfield projects, you could see very clearly in China, BOT, build, operate, and transfer. Usually after 20 or 30 years, you transfer the ownership from the private to the public side. And that is the most common project type in China. And that's very different from the rest of, emerging economies. And Chile, I included in here is because Chile, in the last 20 years or so, has been the most progressive in terms of opening up its infrastructure market to both private and institutional investors, and has been most successful in attracting these kinds of investments, despite its very small size, right? So there are a number of writings about why Chile has been doing well. China, on the other hand, is actually showing a market that's much less diversified in terms of infrastructure space. And there you can see the difference of China. So that's private investment, and that's ongoing for a while now. So you can see the data at the World Bank source starting from 1990, and so that's ongoing. And one of the significant findings is also, particularly for China, a lot of the private investment actually comes from quote unquote south to south investment, meaning from other developing countries, particularly from rest of the Asian regions. Institutional investors, on the other hand, are much newer, right? Some of them are private, some of them are quasi-private. The first type are these what we call pension funds, Canadian teachers' pension funds. So they're not entirely private, right? They're sometimes public. And then insurance companies, so many of them are private. Sovereign wealth funds, and many of them are not private, right? So if you think about GIC or Temasek from Singapore, they're really, owned by the Singapore government, but with a type of market kind of mandate. So it's a sort of public corporation. And they've been investing in infrastructure quite heavily, but not so much in developing countries, which I will discuss in a little bit. Private equity, and that's much more kind of flexible. And asset management companies, which are a little bit similar to private equity because they are about managing private individuals' wealth and a little bit under the radar kinds of investment. And endowments, universities, foundations have these endowments, then they need to make long-term returns. So why are these institutional investors interested in infrastructure, right? You would say, infrastructure, maybe it doesn't return so quickly, right? It's not like a tech company. You have a new product, you have return, your stock market price goes up right away. But I think many believe that infrastructure investment is a more reliable source of income because lots of infrastructure projects are backed or underwritten by governments. And so it has a certain degree of certainty, even though its rate of return may not be as high. It's certainly long-term and certainly more reliable. And the rate of return from my interviews with investors as well as other types of industry surveys that these investors are looking for are in the 10 to 15, so the low teens kind of range annual return. The way that institutional investors invest are also quite varied and diverse, right? Then they don't just invest in infrastructure. They invest in many different kinds of projects and through both equity and debt financing. But if we want to kind of focus here, infrastructure funds actually are the most common way for institutional investors to be participating and be sort of making returns. And these funds are also so-called unlisted. They're not on the stock market. So it's actually very difficult to track in terms of their performance. And so why, is there this very unique space for institutional investors in the infrastructure, right? And they have interests, but it continues to be very small source of investment. I don't have a good figure to show the percentage of infrastructure in total, the sort of that are institutional investors. But in general, I've traced, and you can only find a limited number of unlisted infrastructure funds in China. So my sort of qualitative research of talking to different investors, both in US, in Asia, and within China, and then local governments, particularly the local government financing vehicles that are in charge of infrastructure financing have revealed this, what we call knowledge asymmetry problem in the process. That is, if you look at the international investors or institutional investors, there's the preference for unlisted funds and the preference on late stage and brownfields projects. Brownfields projects meaning the investors don't build. They just come in and they invest in the operation. So it's concessions or management contracts. So in fact, Temasek and CIG from Singapore do a lot of that in the United States, in the cities, like running power stations, investing in power stations, investing in toll roads, but they're not building it. Because again, building it has higher risk, right? We talked a little bit about that earlier. You know, the more you take part in that project, the higher risk you have. And then last but not least is the so-called risk premiums for emerging economies. And I will talk about that real quickly in a little bit. That is to say, investors expect to achieve a little bit higher return if they're going into non-matured economies because of other risks. So it's actually kind of difficult for them to find projects that can guarantee those kind of returns. On the other hand, local governments, especially in China, those that I've talked to really say, well, I'm interested in institutional investors because I think they might be cheaper, right? Maybe even cheaper than Chinese bank lending. It's because, you know, some scholars would argue that the dominance of the public sector in China actually perhaps crowds out private investors. And so because state bank lending is actually at a fairly low rate, so why would local governments want to seek out institutional investors? Because it just may not be as attractive. And the Chinese local governments also prefer to, basically delegate investors to build greenfield projects because then it's less risk for the local governments. And many local governments in China also hope to get into these joint ventures or investment arrangements to have access to other markets. Many of you probably have heard of the Chinese shipping companies and especially port operation companies have been eyeing ports in Western Europe, right? And so they enter into this relationships with big conglomerates globally, not only to get investment, but also to get a gateway into infrastructure projects in other countries. So you can see that, the needs, the demands and supply, there's quite a distance. And it's quite similar to the situation when manufacturing investment first went to China. It's kind of knowledge asymmetry. And so you could see here now, these are the unlisted infrastructure funds in China. Not that many. And also there are lots that are actually domestic, and then from Hong Kong and Singapore and India, these are south to south investment. And then, a few from US, UK, and Australia. Some of the big players like Maguire, Blackstone, and then from England, there's also some of the operators like water operators like Time Water, and then from France, the Veolia water. All of those are fairly typical, and you can see them in the infrastructure space in China, but not that many. And then if you look at the unlisted funds from China, of course, they tend to be from insurance companies, from pension funds, and then from some private equity, right? So they are, you can really basically count them and fairly limited. And so, and I was kind of not surprised, but somewhat surprised to learn that to these infrastructure investors, institutional investors, that it was very similar to when manufacturing companies began to go to China in the early 90s or late 80s. I know I wrote my doctoral dissertation about manufacturing investors in China in the early 90s. And so I studied that, and now, 20 or so years later, I study infrastructure investment. I realized there are lots of similarities. So first is regulatory risk, right? And we can see that quite a bit more now. That is, for instance, how do we set concession rates or fare rates for toll roads? Local governments often, the example would be when a holiday comes, toll roads fees are just waived, and investors are very leery about that. And currency risks. Now, for China, it's less so because it's manipulated exchange rates, but nonetheless, there's a huge control in terms of how much foreign currency or that are earned within the country can be taken offshore, right? So the currency risk is quite present. Demand risk. It is really interesting. I've heard several investors telling me, if you build a highway in India, if you get to build it, meaning you have gone through all the red tapes and you actually build it, there will always be cars on those roads. Not so clear in China. Especially the kind of bypassing tolls kind of behavior is quite common. And so demand risk is not insignificant. And then general business risk. This, any kinds of business have doing in a foreign place, right? So these risks combined together essentially pushes up the kind of rate of return that the institutional investors and private investors would add to their ordinary rate expectations, right? So I said, it pushes up for about, low teens to about 14 to 15%. So with that in mind, now we understand the investor behaviors and expectations and the risks involved in investing in a place like China or maybe other emerging economies. How do we know whether these projects with some form of private investment or international investment are doing, right? It's really kind of difficult. A lot of these funds are not listed. And that's why I was looking both at private and institutional investors, because just to be able to find funds that we can actually track their performance is quite difficult. So I did a little experiment, actually this is a few years ago now, to try to use just basic stock market trading data to track 14 firms. 8 of them are listed on Hang Seng Index. And then a few others are just listed domestically, and try to see what kind of rate of return we can expect annually from these projects. And then method is pretty straightforward, nothing complicated, and really kind of pretty almost back of envelope kinds of calculation. It's not sophisticated, and just to try to see how it comes out. And so the first row is my own calculation, roughly 13%. And the Hang Seng Index overall, right, it's pretty low at that time. And the Standard & Poor's Global Infrastructure Index is also not that high, but again, Standard & Poor's, a lot of the funds are not in emerging economies, so that's actually pretty respectable rate of return for infrastructure investment in mature economies. And then Preqin, which is a very large infrastructure service company in England that tracks infrastructure performances, has about 10%. That's actually really good. And then there's this sort of special index out of all of the firms in China infrastructure space, which is less transparent. So it's very difficult to understand how that is calculated. So my very limited back of the envelope calculation suggests that the rate of return is actually not particularly low, and it's possible that investors, both from private sources or institutional investors, could actually materialize their expectations in the infrastructure space in China. And then, so with all of that kind of both more conceptual exploration and some empirical analysis, together with more conversations with investors and local governments, especially local government financing vehicles. These are quote unquote some of the Chengtou companies or urban development investment corporations. We have my research assistants and I have sort of did a little bit of forecasting in terms of the kind of infrastructure sectors that are more viable for private and institutional investors. This is primarily in China, and so water and wastewater, wind and solar, all basically renewable kinds of infrastructure services. Parking, just as China is began to become very much automobile driven, parking is a big business, and then you can see that actually it's kind of very profitable types of investment activities. And ports is not so much ports construction, but more ports operation. And those with the medium prospects are toll roads, because toll roads have been kind of built out, and then district heating, solid waste, airports. But airports are so much more subject to government and military control because of airspace control in China, and so they do not come quite as high on the investors' radar. And then those with the low uncertain types of prospects in China tend to be shale gas, which is very expensive both to extract and to operate in China, and so it's very uncertain. Non-renewable energy also is so as well, because also the dominance of state enterprises and also the energy policies in China increasingly moving towards renewable energy. Telecom, huge monopoly of the state sector, even though the state sector has broken its monopoly into 3 companies so that they can compete, but nonetheless it's very much state-owned. Transit and urban transport are almost entirely state-owned, but of course at local levels, and most of the deals that have been negotiated with sort of foreign parties tend to be through state negotiations. So if you look at Beijing, Shanghai, Guangzhou, all of these, the subway constructions tend to come from more official sources, with the exception of a few lines that have been negotiated with the Hong Kong MTRC, Hong Kong's Metro Corporation, which is sort of quasi-public corporation. So to kind of wrap this up, I see my time is about to come to an end for my presentation. Really some observations and things that I would like to explore with you, and in terms of your experience, as well as in terms of investment activities that you have seen, is this tapping institutional investors question, that is, or what we call investability, right? It's that I remember this comment I heard a lot from investors, that money is not an issue, right? So quote unquote, there is sufficient amount of capital circulating. And it's whether these investors are going to be interested or not in the kind of projects that really need funding. And so it's no surprise that we see sovereign wealth funds like Temasek and CIG primarily going to European countries, US, mature economies where the political risks are lower and the business risks are lower and regulatory risks are also lower. And then also lots of brownfield investment projects or infrastructure projects. Obviously, we also know that there's an emerging quite, for a number of years now, that green bonds and green investment is now becoming much more important in these infrastructure space. And so those investors looking for more sustained kind of long prospects will see green investment as being more, more fundamental. And on the side of local governments is about a consistent pipeline of projects. So for cities like Shanghai and Beijing, or big cities like Bangkok, it's not a major problem. You can connect with investors somewhat more readily because you have better records, you have more guaranteed demand, but smaller cities in second and third tier regions in all of these countries are going to have problem connecting with investors, and particularly to make sure these projects are not just one-off, but more repeated opportunities, precisely because infrastructure projects involve local governments, that investors will need to deal with local governments, right? And then it's not so easy, in fact, to deal with local governments in different countries. And so this kind of repeated opportunities is really important, and networks are really important. And that, in a sense, speaks to the role of intermediaries and platforms. And so intermediaries such as infrastructure investment or development banks, so the Asian Infrastructure Development Bank that was formed a number of years ago, is an important platform because it connects investors and local governments. And then a number of countries, for instance, Brazil and other countries, have so-called national infrastructure banks. And then in the United States, you have state infrastructure funds, and that are basically pooling smaller infrastructure projects and putting them into a portfolio, and so that can offer investors a more kind of repeated set of opportunities or more consistent pipelines of projects. And in China, for instance, this has been in the form of some, local government financing vehicles that are stronger and better performing, like the Shanghai Chengtou company now is trying to become this intermediary for smaller and the more interior places. So that, let me just wrap it up now. And so we still have 10 to 15 minutes for Q&As, and I see I probably should stop the slides, and then we can go to Q&A, and I can see the questions a little bit more easily.
Yes, thank you very much, Professor Wu, for being very punctual with your presentation. So we're now in the Q&A session. I could kick things off by recalling two questions that were already asked by participants. So first of all, there was a question about whether you have estimates of future land revenues as a percentage of capital costs for large projects such as HSR in China. So that's one question. The second question from one of our participants was, since water and sewage sectors are public service infrastructures for the citizens, how should they have a role in financing these sectors other than taxes? So if you could answer those questions, and then I would also like to invite the other attendees to use the raise hand signal to indicate that they wish to ask a question. Okay, thank you.
Okay, I think the first question, yeah. So the future land revenues aspect is really quite uncertain because the land leasing system, you basically only get revenue when you lease out. And the lease term is anywhere between 30 to 70 years. And so for cities that are very much already built up, you really don't have much, quote unquote, vacant or undeveloped land that you can lease out. And that's why there's a rapid kind of a dying or drop down of future land revenues in China because it's unlike property tax. You do not have annual steady flows of revenues on land. And so that's very, very difficult scenario. And so right now, land revenues count anywhere between 35 to 50% of the infrastructure financing. We will see that running out right around, not my projection, others' projection through IMF. Some researchers is like 2025 to 2035. That is going to run out quite a bit. Okay, and the second question, water and sewage sector are public service infrastructure for citizens. What should the citizens' role be in these sectors? This is really interesting. So at least I can tell you a little bit more about the Chinese experience. I wouldn't call it exactly citizens' role, but small private businesses have been mushrooming in this sector. So in the beginning, in the 90s, in the late 80s, actually, when China first welcomed private investment into infrastructure, water sector and sewage sector was the biggest receiver. So you had these big multinational water companies like Times Water, Veolia from France, which had dealings in China before 1949. And so they were very dominating. But surely, gradually, but surely, that private small businesses, private players within China are growing quite strongly. And so in the last 10 to 15 years, big water companies have all withdrawn from China. Essentially, there's no real profit for them to make anymore. And so they essentially went away. And in China, most of the water or sewage processing plants now have some degrees of privatization, not necessarily to foreign investors, but to local businesses. And so it's probably the most active in terms of private participation in the infrastructure space in China. Of course, I want to also qualify when I initially talked about private participation in infrastructure, PPI, that obviously includes domestic, right? So you could see for China, domestic private participation in infrastructure is also not big, right? So state remains still the biggest, but water and sewage is an exception in that.
Okay, thank you very much for these answers. Now, Peter Morgan, if you would like to ask your question, go ahead.
Okay, thanks very much for a very comprehensive presentation. Had a couple of questions. First, given the challenging nature of the investment environment in China, does the national government have any policies in this area to encourage foreign infrastructure investment, or is it basically all up to the prefectural and local governments?
Yes.
And secondly, yeah.
Sorry. Go ahead. You asked the second, yeah.
Yeah, and the second question, you mentioned ports as being one area as being relatively attractive for infrastructure for private investment. I was just wondering, are there any examples of that in China?
Okay, yeah. It's easier for me to answer the second one. I actually don't have really good examples. I was hoping to look into sector performances, right? Because, my quick rate of calculation, I was actually hoping to do it for different sector. It was incredibly difficult because of the lack of information. And if you look at these companies, and very few of them actually are transparent about their project portfolio. And so I don't have a really good example of that, but there are a number of ports that are very actively managed by private parties. Almost all port operation in China have been sort of quote unquote privatized, right? So near Shanghai and then in Pearl River Delta around there, the management, our operation are all privatized essentially. For your first question, so obviously it's a centralized system. There are some important central government regulations. For instance, actually China did a sort of a 180-degree flip around. So before the early 90s, there was the sort of encouragement of private investment. So there was sort of a guaranteed rate, what we called tariff rates, right, for water, for electricity. But then that turned around in the mid 90s, and essentially there was no guarantee anymore. And so in that space, China's practice is not quite up to the international norms. And so there have been a number of private investors withdrawing from China or suing local municipal governments for the sort of flip-flop of tariff guarantees. And so, yes, a different sector has different policies, different provinces have different policies, but some of the key policies at the central level overrides all of those, particularly on the tariff part.
Thank you very much. And now we have a question by Dina from the ADBI. Go ahead, Dina. Hello, Dina? Okay, so Sita Ram, please go ahead while Dina is getting ready. Okay. In this case, we shall go back to the questions that have been typed by attendees. So if we go to the third question, how good are the land valuation processes and the transparency on land transactions in China? What role is central government playing in this process?
Yeah, so again, it's easier to answer the second part quickly. The central government plays almost no role in this. And for the part on, for the first part, it's very, very locally dependent. But in general, it's been towards more transparent. So the type of land transactions that are now market-based in terms of bidding, in terms of tendering, has been increasing, right? So it's rising up to more than 50% because in 2005, the central government did issue a directive to require local governments to all do sort of market-based leasing process. However, there's a lot of ambiguity and negotiation behind doors for land transfer. But more importantly, is because land transfer fees are fees. They get kept by local governments, unlike any taxes. And so there's a whole lot of incentive for local governments to be more active in land leasing because they get to keep the transaction fees. And it also explains that it is very, very difficult in China. The conversation has been going on for a while, but to implement a property tax is almost impossible because if it's tax, it then need to be submitted partially to the central government because of the Chinese tax system. And so local governments don't really have incentives to turn a fee into e-taxes.
Okay, I think we have time for another question from our participants. If anyone wishes to raise their hand, let me know. Otherwise, we would revert to the questions that are typed. Sita Ram is back. May I ask you to go ahead, Sita Ram?
Yeah, it was an excellent presentation. I'm sorry, I couldn't get my mic unmuted. Now I'm able to. I hope you're able to hear me.
Yes.
The presentation on using the future value of land revenues, I want to just clarify. It'll be good if you have any research or if you have some estimates done in the feasibility studies and so on, how they estimated it. I know it's uncertain, but we want to know because this is now a hot topic. And at ADBI, our former dean, Professor Yoshino, had estimated the spillover effect of infrastructure, which are in terms of tax revenues, but these are empirical results ex post. I would be happy to know for Chinese infrastructure, if you have research or if you're interested, we really want to know or estimate these. It'll be fascinating.
Yes, a really good question. I am, so I haven't done that. I'd be interested in doing that. And, there's this issue of land value capture as well, right? As you invest in infrastructure, it increases land values, right? And then a number of Chinese cities now are about to hit the 30-year mark in which the land lease would need to be either renewed or turned into a kind of either what we call it a property tax system, because a number of scholars do argue this might be an opportunity to do that. So, so land value in terms of how you calculate its future value in the United States, there's a lot of different ways of calculating, but I don't think in China it's that clear. And then that also is reflected. So I'm doing a different type of project to look at how the court sort of plays a role in resolving land disputes. The way in which they calculate future land values is very, very murky. And unless it's agricultural kinds of land, the others are generally based on current values. So yeah, I don't have a good answer for you.
Okay, many thanks. We have time for one further question from Sanjay Grover. So please go ahead, Sanjay.
Ms. Wu, thank you so much. An excellent presentation. I'm just curious because I'm wondering if this is a cultural issue in a way. I mean, in the US, you have the Boston Redevelopment Authority, you have the New York, New Jersey Port Trust. They all use land as an asset, and they all bring the private sector in. In China, land is being used as an asset, but the private sector is not being brought in because it's...
すいません、シータラムです。ちょうどその時、他のなんか連絡が来て、それに答えない。
And I'm wondering if that is because there's a damned if you do and damned if you don't attitude. I mean, because if you undersell land on its value, your job's pretty much at risk. So, and it's a future valuation process, which you really can't, no one really knows what it is. And so I'm wondering how do Chinese politicians or the markets, the leaders, is there just a risk about getting private sector involved in terms of fingers being pointed at them that, hey, they've given up land pennies on the dollar?
Also,
yeah, I don't know.
if I could ask you to be quite brief, if possible, on the answer, and then we would have one final question from Dean Sonobe, and then we could wrap it up. That would be excellent.
Okay. Yeah, I think it's a very haphazard system. I think, just really quick answer, that there's been a research in terms of how local governments behave in that sense, is that there's evidence showing that the more land they lease, the more correlation there is with the kind of upward trajectory of local officials. So land leasing sort of incentives is very, very high, not because of others, but because it drives sort of growth in terms of how growth is calculated, if that answers your question.
Thank you very much. Now we can turn to Dean Sonobe, who can ask his question.
Thank you very much. Thank you very much, Weiping, for very interesting, very nice presentation. One of the most particularly interesting points to me is the mechanism of local government finance vehicle. I knew about it vaguely, but today it became very clear to me. And then this is one of the kind of hidden weapon for China. And then I wonder, because China's system is so unique, it may be difficult to apply to other countries, but there are so many developing countries that need a lot more infrastructure investment, including India. And then, so is there any way to modify this nice mechanism for investment to fit to other developing countries?
Yeah. So I think the one key role that I think it's kind of can be used elsewhere in terms of these local government investment vehicles is that essentially Chinese local governments were not ranked, were not rated in terms of credit worthiness, right? Because for instance, in the United States, if any local government wants to borrow, there's sort of credit rating that allows them to borrow at whatever cost, right? So these local government financing vehicles bypass that and they essentially behave like an enterprise and they raise project finance on the capital markets. And so we kind of make it very flexible for local governments not to have to be, constrained by this sort of credit rating. Now that's on the one side is positive. On the other side is also negative, right? Because then some of these financing vehicles get into very risky investment or financing projects that the returns are not as good. But essentially, the state banks or the Chinese government bail them out. So with the soft budget constraints, you can operate like that. But if in a pure market environment, you can't. So I guess there's advantage and disadvantage to that financing vehicle kind of operating mode.
Well, thank you very much for your presentation. Yeah, you've done an excellent job on keeping everything punctual. We've gone over the time, but I certainly think it was worth it. And I would like to just ask Dean Sonobe to make some closing remarks. And once again, thank you very much.
Yeah, thank you very much, Professor Weiping Wu again. And we will look forward to your coming back to our seminar. And maybe next time we will see you in person. Okay, thank you very much once again.
Thank you all very much. And Ron, I see your name up there. I hope to meet you at some point. I wish you all the best. I do come to Asia a lot, but hopefully soon again.
Yeah. Stay safe and healthy.
You too.
Thank you very much. Bye.
Bye-bye.
Bye-bye.